Hey, good afternoon, everybody. We're going to go ahead and get started. I want to first of all, we were going through some technology challenges literally right before we started this call, so got everything lined up. Hey, I want to first and foremost, on behalf of the entire Gryphon Financial Partners team, hey, I want to welcome you to our first webinar of 2026. Signals versus noise, the things that actually mattered in 2025, and what to do in 2026. My name is Randy Bellmer. I'm managing executive here at Gryphon. And first thing I want to do is just give a sincere thanks to all of our clients for entrusting us and allowing us to serve you. For potential clients and others that are joining the call today, really appreciate the opportunity to share some insights. And obviously, if there's ever an opportunity to learn more about you or your situation, we would love to have the opportunity to do so. Our purpose here at Gryphon is straightforward. It's about making people's lives better. And I want to tell you that everybody on this team is ensuring we're doing everything possible to make certain that that happens every day. For our format today, I'm extremely excited to have two of our senior investment professionals, Mark Fleming and Bob Swansboro. Mark is in the blue jacket, and Bob is in I guess that's a taupe, kind of a green jacket, Bob. I like it. Mark brings 20 years of investment and wealth management experience across public markets, hedge funds, and private equity. His background includes trading, analytics, and performance management across both domestic and global markets. He's a chartered financial analyst and a financial risk manager. Bob brings over 25 years of investment and wealth management experience across portfolio management, investment research, trading, and liability management. He's had prior roles that have included leading and being a director of research and trading, as well as managing assets and liabilities. Bob holds his CFP designation. Thanks to both of you guys for being here. Really looking forward to it. Our format today is going to be primarily revolving around Bob and Mark taking us through a presentation deck. About the last 10 minutes, we'll wrap up and do a Q&A session. We received a lot of questions from you. We'll do our best to get through as many as we can, but and keep in mind the constraints of our time. But I would tell you, any questions that were submitted, if you don't get an answer, please reach out to your advisor, and we'll make certain that we get you an appropriate response. So with that, hey, 2025, I don't think finished anywhere where folks were saying it was going to finish when we started it, and then here we are in 2026. So Bob and Mark, looking forward to it. Bob, I think you're going to start us off.
Yes, sir. And for sure, nobody really expected 2025 to be the kind of market in terms of returns that we experienced for sure, especially considering in 2023 and 2024. And when I reference the market, I'm talking about the S&P 500, but we had 20 plus return years for each of those. So, I think people's expectations in 2025 are a little subdued, but nonetheless, we end the year and the S&P 500 is up about 18%. Probably one of the bigger surprises, I guess, for last year was the returns that we garnered from international and emerging markets. Both were up over 30% for the year. I know we're going to talk about that a little further in the presentation, but again, I think that was a surprise to investors. But we pretty much had positive returns across the board. Mid cap, small cap stocks were up somewhere around 11 or 12%. And even when you look at the fixed income side of the house, you had taxable bonds that were up about 7%, and municipal bonds were up about 4% for the year. So, probably another surprise, and again, I know we're going to talk about these things a little further, but when you look at the hard asset side of the house, I guess more particularly gold and silver, gold was up about over 60% actually last year, continues to perform well this year, and silver was actually up north of 100% last year. And again, we're seeing that sort of carry through into 2026. I know we had a question around that, as well as, again, we'll talk about this further along in the presentation. So, but again, just to recap, 2025 was a great year across the board. And yes, we'll talk about a little bit the outlook a little further along in the presentation. One of the things, I guess, that fueled the returns last year when you look at interest rates, and this chart in particular is the 10-year yield. You can see we started off the year last year somewhere a little north of 4.5%. We jumped up, to around 4.75. That was about the middle of January. And then you can see for the rest of the year, we basically trended down. We ended the year somewhere around 4.17%, a little short of 4.2 on the 10-year. And, the reason that this is important, the 10-year yield, of course, is a benchmark with regards to a lot of lending rates, especially mortgages. So hopefully, if we can continue to see this trend down, it should help parts of the economy, especially in housing. And we're going to talk about that a little further ahead as well. We also had last year the Federal Reserve actually cut rates 3 times. We started the year around 4.25 to 4.5% on the Fed funds rate, ended the year about 3.5 to 3.75%. So again, short-term rates were coming down as well. And I know we're going to talk a little further ahead in terms of expectation for rate cuts from the Fed for this year as well. But interest rates, of course, played into those positive returns that we talked about a little earlier. We heard a lot of talk around inflation, especially over the past 2 years. We had higher levels than we normally experienced in terms of inflation. But when you look at what happened last year, inflation, even though it continues to be sticky, and what I mean by sticky, the Federal Reserve, has a target on inflation to be about 2%. And when I talk about inflation, I'm talking about the consumer price index. So, right now, I think we ended the year in 2025, somewhere around 2.7%. So we're in between that 2 and 3%, inflation reading. So again, somewhat sticky. When you look at this chart, this is sort of 3-month average in terms of CPI. But, again, you can see things trended down a little bit and have been holding steady as of late. But again, still a little above the Fed's target rate. The good thing is, though, we did not experience any hyperinflation from the tariffs that were enacted last April. So I think the market applauded that a little bit, and hopefully we continue to see that as we move forward. We've also seen accelerated GDP growth. This is, a quarterly look, I should say, at nominal GDP quarter over quarter. When you look at last year, nominal GDP growth was about 5%. But you notice there was a spike up there in the third quarter. If you look out to the far right of this chart, it was about an 8.2% reading in Q3. So again, positive readings out of GDP growth as well. That certainly helped and was applauded by the markets when we look at returns for last year.
So this is one of my favorite charts. I call it the aggregate income chart, which is really just kind of economist speak for the total income across the economy. And we're looking at how that total income across the economy is growing year over year, and then breaking it down to its components. So really, at the end of the day, what consumers have to spend is going to be a function of what consumers earn. Of course, they could save or they could spend down savings, they could run up credit card debts. But generally, what they spend is going to be based off what they earn. So looking at the recent trends, so we can see there's these blue bars here that show the contribution of bringing in new workers to the workforce and how that grows total income. So obviously, one way you can have people as a whole earn more money is bring in more people. And as we've run through the kind of the post-COVID era, we've really run out of slack on the labor force. And you can see that the contribution to growth from bringing in new workers has really started to slow. So you see that dark blue bar really go down. Now, the good news is that that's been offset by wage growth for those that are in the workforce. And those orange bars are actually inflation-adjusted wage growth. So this is adjusting for inflation, looking at true inflation-adjusted growth. So we're seeing wage growth pick up, and we actually think that will likely accelerate. Now, this is declining, but we're not overly concerned. This actually lags, just to give a little tease for something later that we'll talk about. There's an index called the ISM Manufacturing Index for new orders. We'll talk a lot about that later. This tends to lag that index by about 9 months. So we have some optimism about where we're going. And also, one other real key piece of information you get here is these gray bars, which is the hours worked. So the first thing that an employer does when things start to slow down is they're going to cut hours for their employees. So if we saw a real slowdown in the economy and real concern, we'd really see a much bigger negative contribution from those gray bars as employers started to cut hours, and we're just not seeing that right now. Now, inflation has been the big sticking point for the last few years, especially coming out of COVID. We got used to a very long period of very low inflation, and we had a period of high inflation. Now, this is just looking at the actual inflation index. So a lot of times when we talk about inflation, we just look at year over year, month over month changes, but it's actually measured in an index. And what we're showing here in this orange bar is actual prices, and the blue bar is wages. So as you can see, prices went up faster than wages, and that's where consumers really felt that squeeze. But the good news is that that's starting to adjust and starting to normalize. And according to our most recent print, we're getting really close to a point where that's going to cross, and wage growth is going to offset that pricing increase. And of course, as Bob mentioned at the beginning, tariffs were expected to have a really negative impact on the economy. Really basically anywhere other than our last webinar where we said we didn't think tariffs were going to send us into a recession or cause hyperinflation. That really was kind of the consensus view in early April, and we saw markets react to that. What's happened throughout the year is the tariffs have been much smaller than anticipated. So the blue bar is just what the consensus projections were for the tariff rates, and the orange bar is what actually was realized. So the impacts of tariffs have been, much less than feared when they were originally announced.
So if we had to point to, I guess, one thing that actually drove economic growth last year, and you probably hear a lot of hype and buzz around it, but of course, artificial intelligence has, sort of come to the forefront. You listen to the chatter on TV around the markets and things of that nature. So, of course, what we have occurring is we have our larger tech companies, for example, your Microsofts, your Googles, they're actually starting to spend on the artificial intelligence build out, to the tune of somewhere between $300 and $500 billion. So again, you look at this left chart here, and that's pretty much what that represents. You can see the amount of spending that is being pushed towards this AI build out, probably more particular data center and building the infrastructure around AI. The other thing to keep in mind with these new data centers that are being built, the amount of electricity that's going to be needed to power these data centers is going to expand. I don't think any of us can imagine how much, but just looking at what's projected in terms of electricity consumption for next year, we're looking for, or at least analysts are looking for, I should say, an increase of 20% in terms of electricity consumption year over year in 2026. So again, that's sort of what that right chart is depicting as well. Just staying on this topic here for the next chart. If you look here, this gives you an idea in terms of the amount of tech capex being spent on artificial intelligence versus some of the other capital spending projects that occurred over the years, whether it be infrastructure or for example, technology in year 2000. But you can see if you look out there to the far right, the tech capex for 2025 is actually pushing about 2.1% in GDP. And that's far exceeding a lot of these other projects that you could see through the years have been implemented. So, again, lots of spending going on, and that's certainly been powering the economy, especially in 2025.
So now all of that spending on AI capex, the hope is that that's going to result in future GDP growth. And so what we're looking at here is this. There's a measure that economists use called potential growth. And what that looks at is it takes into account the number of people in the workforce. Sorry, the working age population. So how many people are of age to be in the workforce? It looks at the capital stock of the economy. So plants, property, equipment, its capacity to produce, and they say this is the potential for the economy. The orange bar actually shows where real GDP, actual realized GDP comes in historically. So you can see the potential GDP and actual realized GDP do have some relationship. Looking forward, the expectation would be for declining potential GDP. This is from the Federal Reserve. This is their estimates. And what's driving that decline is the workforce, decreases in the size of the workforce and aging of the overall capital stock. So we have two factors that can possibly reverse that trend. So one of them, the black bar, is just the potential impact of AI on productivity. Because effectively, what we can do with AI is bring in new workers. So in the past, without AI, effectively to add a person to the workforce, it takes 18 to 22 years. With AI, you can create a new worker right away. So you can have a more immediate impact on the workforce as you bring in that AI workforce, and that should enhance the productivity of the economy. And that's the goal of all this CapEx, is to ultimately increase the potential GDP of the economy. So looking back on 2025, really, the big keys of the year, it was, very strong equity markets, driven by actual earnings growth. So that was a really healthy market. It wasn't driven by multiple expansion. It was driven by actual company earnings growth. We had both interest rates and inflation cooling. Of course, that supported those asset prices. The market is adjusting to the volatile political environment. People have an amazing ability to be resilient and adapt to things over time. So the more and more we have, bigger announcements that might be perceived as, market negative or introducing volatility, the market just gets more and more used to those, and they become more of just part of doing business. So you see each time there's a big announcement, it's going to have a less and less of an impact on the market. And the big theme is today's CapEx going to be tomorrow's productivity? So as we look ahead to 2026, recapping is the easy part. Let's do the hard part, which is trying to see, where we're going for next year. We use a framework that was developed by, Mike Kantowitz at Piper Jaffray. I got to give him credit for this framework of how to spot market cycles and turns. And what this framework he's developed, it's called the Hope framework. So it's looking at how different economic indicators respond and in what order they respond. So the idea is that housing is usually the first area of the economy to turn because it's the most interest rate sensitive, followed by new orders for manufacturing. So when people buy houses, they tend to buy other things. They buy furniture. They remodel their kitchen, they remodel the bathroom, they buy a car. So that housing activity tends to start to jumpstart other activities across the economy. Those new orders for businesses, of course, are going to lead to new profits for those businesses. And then as companies start to see that profit increase, and they're going to start to add employees. So it's really looking at how different economic indicators flow through the cycle, with typically the earliest to turn are indices from the National Home Builders Association, with the very slowest to react being the inflation numbers, which is one of the reasons why the Fed's job's so hard.
So Mark had mentioned about the first of that previous chart, the first letter there, H, being housing, of course. And you probably know this, of course, housing's been in the doldrums here for at least the last year or two. And, this chart actually depicts some of the reasons as to why that is. When you look, in this chart, the blue line actually represents monthly rent payments. So, if folks are renting apartments, things of that nature, where those payments are. And then you have those current owners of mortgages that, are lower than what they are now, including myself. A lot of folks have 3% mortgages or lower. So again, those folks are pretty much holding in terms of where their payments are. But you look at that green line, when folks are actually going out to buy houses now, and when you look at the current 30-year mortgage rates, it's around 6%. You can see why housing remains, a little frozen in terms of things, because those payments are much, much higher, with regards to where mortgage rates are. So, that you have these current owners and they have these current mortgages, 3%. Those are very hard to give up. And there's a lot of folks that aren't willing to, go out and look for a new house because they know their payment's going to be higher. So I don't want to say they're stuck, but they're pretty much happy in terms of where they're at on the housing side with their payments. So, where we've seen the activity, at least here over the past number of months in housing, it's been around more activity in government type loans, so VA type loans or FHA loans. Those rates tend to be lower. The other thing, on the new building side and construction side, you have a lot of builders that are actually, buying rates down and things of that nature to close deals. So, again, that's a small part of housing activity, but, with interest rates being, higher than what we've experienced, at least over the past 5 or 10 years in terms of mortgages, that's certainly put a little bit of a freeze on housing. Hopefully, we'll see that start to turn around. We talked about interest rates hopefully trending down, but nonetheless, that's where we're at least for now. We've actually, when you look at spreads, with regards to mortgages versus, I'd mentioned earlier the 10-year Treasury yield. Those are a little above average in terms of things. There's some reasons for that. You probably know this. Mortgages are typically, if they're sold, they may be packaged in the mortgage-backed securities, and investors in those types of securities, at least at this point, they're requiring a little more yield because of some things around prepayment risk and some other things like that. So that's one of the reasons as to why we're seeing spreads a little higher than historic average. The other thing, the costs around closing mortgages, for example, servicing, originating, guaranteed costs, those are actually higher than normal. And again, that's part of the reason as to why we see these spreads a little above the historic average. Certainly not helping on the housing front for sure.
So looking at how housing can, impact that second part of that HOPE acronym. So as we're starting to look at the new orders, which we specifically focus on manufacturing for those new orders. The U.S. is a service-based economy. The service portion is larger, but the manufacturing is more volatile. So it gives a little better signal of where things are going. So that's why we look at the manufacturing side, and it tends to give a better indication of where we're headed. So this blue bar, it's just the Mortgage Bankers Association index of mortgage applications to buy a new house, and just looking at how those change over time. And that has a pretty strong impact on new orders. So it's not a perfect relationship, but you can see over time that those new orders tend to follow that, those new home purchases. And then looking at a few other indicators that tend to lead that new orders index. So we have the lagged effect of the Fed funds rate changes. So again, this is another factor of why it's so hard to be a central banker, is that you've got about an 18-month lag from when they actually raise or lower rates before it actually really starts to hit the economy. And this year is when we'd start to expect to see, some of that impact. And just a few ways to confirm that is looking at, another way to look at that. We're going to look at this blue bar here. This is going to be the relationship between the new orders and the 2-year yield change. We have a long-term view to just kind of show that they're related. And then we zoom in a little bit down here on the bottom right. As you can see, the impact of the changes in interest rates, really starting to expect to see, that hit the real economy this year. So, we're expecting to see a pickup in those manufacturing orders. Another indicator that can lead that is oil prices. So we're just looking at changes in oil prices and their impact on those new orders. Again, as oil prices come down, that frees up money that can be spent on other things, lowers costs. Most things that are manufactured need to be shipped. So it's going to have an impact on overall demand. So the decrease in oil prices also signaling a potential increase in new orders. Again, the 10-year yield, which tends to follow the Fed funds and the 2-year yield, but not always. We can see that looking at the lagged effect, so it's about a 2-year lag in the changes in interest rates, and once they hit the real economy, again, that 2-year lag is signaling that new orders should start to pick up. And then looking at to bring in a different indicator rather than just the new orders for manufacturing. What we're looking at is trucking rates. So these are spot rates. So the rate today to ship something across the country or across the state. The orange bar, we're just looking at the relative performance of the transportation stocks. So in this instance, we're looking to the market to see what it's pointing to. And you can see that it tends to lead the actual spot rates for trucking. And the market's starting to sense that there's going to be an uptick in rates. And probably one of the reasons why they're sensing that is if we look here, this orange bar, these are going to be the trucking rates, and the blue one is the change in the 10-year yield. You see, again, that stimulative effect that comes into the economy as interest rates decrease. We're at the point where, literally the rubber meets the road here with trucking spot rates. We're signaling that there's likely going to be an increase in demand for trucking and shipping, which means there's something has to be manufactured before it gets shipped. And then moving to the P part of the acronym, this is just showing that those manufacturing new orders are somewhat coincidental with corporate profits. So what that means is that they tend to happen at the same time. So the orange bar here is total profits across the economy. So it's not just the S&P 500 companies, it's all businesses. So we're looking at the growth rate of earnings across all businesses. Now, of course, this is size weighted, so the big companies are going to have a bigger impact, but everything is included in here. And you can see typically as those new orders start to go up, profits start to increase as well. So we'd expect all of that to flow through into earnings, which then can help stock prices. And of course, for those of you that own your own businesses, we could expect to see that come to activity to your business as well.
Certainly, when we look out for this year in terms of what we think is going to happen with the market, we certainly have some fiscal tailwinds that were implemented around the tax legislation that was passed last year. This slide just gives you an idea in terms of estimates for federal tax refunds. And you can see they're expected this year to actually move up, around 44% to about $517 billion. And if you look down to the bottom right there, there's the reasons for that. Of course, we had the SALT cap increase around state and local taxes, the overtime deduction, senior deduction, no tax on tips. All those are playing into the fact that we're going to see, refunds higher this year, and that should certainly spur consumer spending and economic growth.
And just to kind of hit the fiscal stimulus, really take that point home. So as we talked about, we have an economy that was already set to do well, and we were already poised for some acceleration in the underlying economy that's going to receive a lot of different levels of stimulus. So, the first one here is the Fed balance sheet. So, what the Fed had been doing up until about the fourth quarter of 2025 is they were letting the bonds on their balance sheet run off. So effectively, what they were doing is, as a bond that they own matured, they just wouldn't go and buy another one. And what that does is it effectively takes money out of the economy. Well, it towards the end of 2025, they realized that their level of reserves, which is basically Fed speak for money in the economy, was getting too low, and they started to reverse that trend. So in 2026, they're expected to purchase about $350 billion in bonds. So that's about a $552 billion swing in the net effect. On the tariff side, tariffs are expected to have less of an impact in 2025 than 2026. Again, this could change as new tariffs get announced all the time, but it being a less of a drag going forward is about a $79 billion contribution relative to last year. On the fiscal side, we have the tax cuts and the tax refunds that Bob just mentioned. That's going to add, this is a different firm giving an estimate. So this firm estimates about $367 billion of stimulus from those tax cuts that were enacted last January. And then a little bit more obscure, there's some changes in bank regulation. So there's a certain category of banks that are called the globally systemically important banks. Just think of that as really big banks. So that's your JP Morgan, Citibanks, Bank of America, Wells Fargo. And there are certain rules about how much capital they need to hold against their assets. That changes for this year. And long story short, what that means is about another $200 billion in lending capacity is going to be opened up across the economy. So all in all, that's about a $1.2 trillion swing in the fiscal impact for an economy that looked like it was already poised to do well.
Certainly a lot of chatter on the Federal Reserve these days, of course. We have Fed Chairman Powell, whose term is up here in May. So, a lot of market watchers are looking to see who the presidential administration will place in his chair. Of course, we're looking for the Fed funds rate to actually be lower this year, as well as the market is. So in terms of where the market's looking for the Fed funds rate to go this year, I believe they're looking for 2 cuts. That would bring us down to a Fed funds rate of about 3%. I believe, they would consider that at least neutral. But again, the Fed tends to be data dependent, but, we might see a little more in terms of them being ahead of the data as they look at economic readings and things. I know the current administration wants to move rates lower, and certainly that could occur this year. Again, the market's looking for 2 cuts of 25 basis points apiece.
So if you want to get into the mind of a central banker, really one of the most important concepts to them is the neutral rate. So now the neutral rate is essentially the Fed funds rate where they believe they're neither stimulating the economy or doing anything to slow down the economy. And now what's really difficult about that neutral rate is you never actually know where it is. It's unobservable. Nobody knows what the neutral rate is. So the Fed never really knows if they're working to stimulate or they're working to contract the economy. So the best estimates we have are, some of their economic projections in the market. So what we're looking at here is the blue line is just the actual Fed funds rate. So we can see how that's come down over the last couple of years. Now, the orange line is what we use as a proxy for the market's view of what the neutral rate is. And so what this is, it's just a forward swap, 5 years forward to buy a 1-month treasury bond. So it's effectively what the market thinks the 1-month interest rate will be in 5 years in the future. And because 5 years in the future is just very hard to predict, it's just viewed that that's generally everyone's assumption of the long run. And then the gray bar is the Federal Reserve participants' view of neutral. So every quarter, they publish their SEP, their supplemental economic projections. They give their estimates of things going forward. And in that, they show what they think the long run interest rate should be. And that can be viewed as their long-term view as neutral. So this is where you get some discussion about where interest rates should be. So according to the Federal Reserve participants, more well, that gray line is going to represent half. So the vast majority of participants think that the Federal Reserve rate is tightening. So it's restricting the economy, and that's why they want to bring it back to neutral really quickly. And then, of course, you can see that the market thinks we're at neutral. So one of the reasons why you are seeing so much talk by some Federal Reserve participants about large cuts in interest rates is because they think they're in that restricted category. And as they've seen slowing in the labor market, they don't think they should be restrictive. They think they should at least get to neutral. So there is a divergence here between where the market is and where the Fed is itself. And so the good thing is, of course, the Fed's going to be very focused on future inflation. So, one factor that gives us a really good look at where inflation is headed is changes in commodity prices. Those can flow through to other prices. Commodity prices have been relatively flat. We're looking advanced about a year. And that'll show that given that factor, that we expect inflation to remain high but stable. So we're not looking for runaway inflation based off that factor. Another factor that can flow through to inflation is wages. So if you have prices go up without wages following, that means the prices are going to have to fall back down because consumers don't have the money to pay those higher prices. So looking at the actual wages and salaries across the economy, on the left, we're looking at the quit rate, which comes from our JOLTS report, leading by about 9 months. And what that's really showing is that when people leave their job to go to another job, they tend to get a higher wage. So fewer and fewer people are leaving their jobs to go and get a higher wage, which is signaling a reduction in overall wage growth. And then on the right, we have just another way to look at it. This is using the Indeed, the job posting board. They have data on what employers are paying, and that leads by about 9 months. So we're seeing a reduction there. So it's not that wages are going to go down or anything bad like that. It's just that the growth rate is slowing. And, for consumers, we want to see a high growth rate in wages. But for inflation, it does show that the likely inflationary pressure going forward is relatively low.
This slide depicts, where job openings were versus the number of unemployed people. And if you look there, of course, the orange line, the unemployed people line, the blue line is the job openings line. You can see there was quite a spike there, around COVID time. But what we've noticed, especially when you're looking out to the far right there for 2024 and 25, those lines have converged. So, basically, the number of job openings versus the number of unemployed, there's pretty much equal there. And what does that mean? Pretty much a more balanced job market and balanced employment situation, which should take some of the pressure off wages and should be a good thing there, as well as, on the inflation front when you're talking about wages. So again, more balanced job market. Households are in good shape. When you look, at this chart, this goes back to 2006. When you look at debt service payments versus a percent of disposable income, you can see, that line, although it trended up a little bit, 2023, when you look out there to 2024 and actually into this year, those numbers have remained rather stable. So again, just part of playing into the fact that households look to be in good shape and consumers are spending. This chart sort of shows when you look back to 1990 and look at the numbers in terms of the amount of cash available to invest for households. Household cash is a percent of total financial assets. You can see, that number is about 7%, and that's a 98th percentile number. So again, cash within the household has grown. You can see quite a bit since 2020. And of course, the consumer plays a big part in the economy, and that cash there, they tend to spend. So again, good story for a consumer on the economic front.
So, we've went through, we looked at the economy, we looked at the state of the consumer. So far we're seeing lots of positive things. We're ultimately interested in how that's going to impact the market. And so that's going to come down to our valuations and kind of the expectations of how that's going to play into actual market prices. Now, this is the way that most people look at the market and determine whether it's overvalued or undervalued. And this is really the wrong way to look at it. Because if you look at the overall multiple of the index as a whole, it really misses the fact that businesses in different industries should sell for different valuations. They have different returns on invested capital. They have different profit margin profiles. So as the makeup of the market changes, that can have a big impact on the overall price to earnings ratio of the market. So if we're looking at this chart, we have years here really, the early 2000s and the early teens where the multiple was much lower. And that was when the market was really dominated by banks and energy companies. And they were some of the largest weights in the index. And those are lower valuation industries. So you tend to see them trade at lower multiples. They generate lower returns than, say, technology. So really in the late 90s, very early 2000s, we had the multiple go up. There were some silly things going on there, but some of that multiple going up for the market was just because the makeup of the market had really moved to more technology focused. And that's what we're seeing here in 2020 and 2020 going forward, as tech and communications have really become, the dominant industries in the market. That's pushed the multiple higher. So really, you want to look at the valuations across a single industry over time, not at the market as a whole. But we can kind of break this down a little bit and see what should be driving multiples in the overall market. And this just shows the relationship between the valuation for the market. So the left side is the price to earnings ratio of the market. So that's how much we're paying for $1 of earnings. You can see and then on the bottom, that's going to be the profit margins of the business. So these are both forward-looking. So these are the expected profit margins. You can see there's a pretty strong relationship between the two. As profit margins go up, the valuation goes up. And the same thing if you're looking to buy, do some M&A for one of your companies, the better the business you're trying to buy, the higher valuation you're probably going to pay for it. Today, we're sitting right on the line. So this data point here at the end that's almost right on the line is where we are today. So yes, that price to earnings multiple is higher than it has been historically, but it seems to be justified by the profit profile of the overall market.
And a good lead into this slide, when you look at strategists in terms of what they're projecting for earnings growth in 2026, they're basically looking for somewhere around 15% earnings growth for the year. So again, I think Mark had mentioned earlier, we had a great year last year in 2025. Most of that had to do with the fact that earnings powered the market higher, and strategists are expecting the same thing this year. And you look out to the right there on this chart, you can see, profit margins are on the rise as well. Third quarter of 2025, you can see the profit margins for S&P 500 companies was about 14%, and strategists expect that to rise as well. All positive, good things for the market. Small cap stocks have lagged when you look over the past number of years, at least the past 5 years. This may be the year 2026 where small cap leads the market. The reason I say that, when you look, for example, at the Russell 2000, which is an index of small cap stocks, there are a lot of companies there that are debt laden. and interest expense is a large part of their overall expense profile. If we do see interest rates start to move lower, that's typically a good thing for small cap stocks because they can look at refinancing debt. Of course, their interest expense could go lower, and again, could mean increased earnings for those types of companies. So hear a lot of chatter about that in the market, and what we've seen so far in 2026. Small caps have been one of the best performing sectors of the stock market.
And understandably, it can often be kind of scary owning stocks or putting money into the market when it's at an all-time high. So this is just showing the forward returns of an investment made when the market's at an all-time high versus all other times in the market. And you can see, they're really pretty similar. There's not much of a difference, and that they're all positive over 1, 3, and 5 years. So that doesn't mean you can't have a 1 year period that is negative, but on average, it's positive. And 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 that doesn't mean you just always want to blindly buy the market. If some of the indicators that we were looking at were showing the other direction, right? If it was, or if we were seeing signals that new orders were going to head the other way, or we are starting to see the workforce having their hours cut, we have kind of shadow job loss, and the market's at an all-time high, that's a different case. But, today with things looking good, we'd say don't fear the all-time high. So really kind of just to summarize, what we're expecting for 2026, the biggest thing is that we already were expecting the lagged impact of interest rate and Federal Reserve activity to really start to drive the economy this year. And then on top of that, we are bringing in a level of fiscal and monetary stimulus on top of that that should have a more immediate impact on the economy. Households are in good shape coming into the year, so we don't really necessarily need to say have a year of balance sheet repair for the consumer. They're generally coming in fairly good shape. Market looks, fairly valued. It's right about where it probably should be. And analysts are expecting 15% earnings growth for 26 and 27. So it does look like a fairly strong setup for next year. Now, we always want to be aware that there's always risk and there's always downside and there's always things that could, cause this to be wrong. So I'll let Bob maybe hit the first couple risk points.
So yes, of course, investment sentiment, if we get to the point where that is too hot or overheating, of course, that can bid up stock prices in terms of things, also cause, a lot more volatility. And, we could see a sell-off in that type of situation. So again, something to keep an eye on. We had talked earlier with regards to interest rates and them trending lower, as well as inflation staying in check. If we would start to see inflation numbers spike, which would cause the Fed to change its stance in terms of moving interest rates lower, that of course could be, a hiccup for the market as well. Although, that is not our base case, at least at this point. But again, those are two things to keep an eye on.
And a couple other risks to keep an eye on. So we're watching things that are happening in the Japanese market. We have seen interest rates really start to go up there, and there's some concern that the rapid increase in interest rates, especially from a low level, could break the Japanese economy. One of the reasons why we watch that, or really there's two reasons why we would watch Japan, is one is that there's always been this watch for the effects of debts and deficits in the United States, and that there's eventually going to be, some day of reckoning for the debts that we've run up and the deficits we've run. And really people have been very focused on that since the 1980s. And generally both the markets and the economy have done well, despite those factors. And Japan's always been the leader. Their debt to GDP is dramatically higher than ours in the US. They have larger deficits. So if there's ever going to be an issue in the sovereign bond market for developed countries, it's going to happen in Japan first. So it's not our base case, but it's something we're watching as interest rates are rapidly starting to rise there. We've already seen the Treasury and the Federal Reserve started to potentially intervene in the US dollar yen market last week. So it's something that's kind of happening now that we're keeping an eye on. We don't think it'd have a long-term impact on the economy, but could cause, some short-term volatility. And also, the Japanese yen tends to be a good funding market for other trades. People like to short the yen and invest it into other things. We saw that trade kind of implode in August of 2024. So we're seeing less and less of that, but that's still a risk. Another one that we hear, I can't turn on CNBC without hearing about the AI bubble. It's very possible that we are in an AI bubble and that companies have overinvested in CapEx. I have a hard time seeing that. I was fortunate enough to have covered semiconductor stocks, as going back to 2016, is able to go to a lot of semiconductor conventions and hear about where things are going. And I think we're just still really in the early stages of AI as AI comes into the physical world. So, the great analogy I heard at that conference is, at that point, a smart garage door is one that knows whether it's open or closed. In the future, a smart garage door knows if it's breaking down, if it needs work, it orders its own parts, it orders its own repair. It takes care of itself, and then extrapolate that across everything in your house, everything in a manufacturing facility. And that's going to require a lot of compute and a lot of power. So I still think we're very far from where we eventually need to be. Could adoption take on slower than the actual build out? Yes. But I wouldn't see that as a disaster. It's probably more of an opportunity.
Okay. Hey, Mark and Bob, clearly you guys have a passion for what you do, and really appreciate all the insights and sharing there. That was a lot of good stuff. We won't get through the questions. I'm going to pull a few of these out that connects to the what you just shared with us and get your insights. And I'm going to start with you, Mark. Early in the discussion, we talked a little bit about gold, and there were some questions around expectations for gold and silver's performance in the broader market, and just really the whole mineral asset class as a whole.
Yep. So we did put a chart here. So, generally over the long term, gold and silver have not been a very good wealth accumulation vehicle. It tends to have periods where it shoots up, but then it goes back down. And there's kind of the old analogy that it tends to take the stairs up and the elevator down. And right now we're seeing it go up. It almost looks like it's using the elevator, because we're seeing some things. It's more of like a GameStop style squeeze, short squeeze in silver that's really driving prices higher. So it's something that we wouldn't expect to continue for the long run. It's probably not something you'd want to make an investment in. It's gold and silver are trading vehicles, not investment vehicles. So generally, we typically don't recommend investing in it for clients for that reason. And that looking at this, you really have to get your timing right to make money in those markets versus if you're in the equity markets, you can generally buy and hold. So we don't think it's a good long run asset. We're not recommending it. It's really dangerous, the prices, how they've shot up very quickly. And it's more on technical factors than fundamental, which could reverse very, very quickly and send prices back to where they were before they started.
Okay, thanks, Mark. Hey, Bob, I'm going to pivot to you. We talked a little bit. We talked a lot about rates and those sorts of things. And every individual has a different asset allocation based on what they're trying to accomplish. So how much they have in bonds and equities and cash. And a couple questions came up around the bond market in general and thoughts for what we might see in 2026.
Yeah, so 2026, we're actually, expecting a reasonable year in terms of bond returns. So what I mean by that, typically bonds return somewhere around 3 to 5%, 4 to 6%. So I would say, with this type of environment, taking into consideration, possible lower interest rates and such, we can expect a pretty reasonable year in terms of bond returns, and I would say somewhere in that range that I had mentioned. In terms of within accounts, if we have taxable accounts, we still think that there's a lot of opportunity on the municipal bond front. So if we can utilize municipal bonds, of course, it depends on the client's tax rate and such, but if we can use them, we see a lot of opportunity in the muni market. So, again, probably a reasonable year, but somewhere in terms of returns for bonds, somewhere around 4 to 6%. I know there's a question there with regards to allocation, and of course, that always depends on a client's financial plan or risk tolerance in terms of things. But I would say, we're recommending an even to slightly overweight allocation to equities with a tilt towards international emerging markets and small caps for some of the reasons that we mentioned within the presentation. And, pretty much an even weight allocation of bonds. And again, probably more of a tilt toward intermediate maturities, not looking to extend maturities or duration, at least at this point. And again, if we can tilt an account towards municipal bonds when it makes sense for a client based on their tax rate, we're going to do that. So I don't know, Mark, do you have anything to add on that? But that would be my sense in terms of where we're at.
Yep, you're on mute, Mark.
Nope, that was great. We'll let Randy hit a couple other questions.
Yeah. Hey, Mark, I'm gonna jump over to you and talk more about kind of like, we're a year into a new administration and lots of policy changes and we deal with this stuff. That the question was, how do you take all that in when you think about investment and portfolio decisions?
So, we really have to sit back and look at, it point by point. Like it's really easy to get very emotional about politics. And, we really have to sit down and, separate the emotions and look at how something is going to impact earnings and multiples. So, I always say there's things going on the news, something can be a human tragedy, but it doesn't mean it's going to be a market tragedy. And so we're really trying to sort those things out. With this particular administration, they do have a fairly predictable playbook about how they go about things. And one of what's difficult for many is that first step of the playbook is to do something unexpected or to do something to make a very big ask. So knowing that that's probably not really where they're trying to get to and trying to figure out, what the real goal is and that it's probably not what was initially announced. So we, break it down, try to figure out what they're really trying to accomplish, and then figure out how that's going to impact the market.
All right. Thanks, Mark. And then we think we've got time for maybe one more here at a minimum, or a maximum. Bob, we talked a lot about markets and kind of set a temperature for feeling pretty good about where the economy is going. If you think about it from a sector standpoint, again, we're coming off this tech, AI, 40+%, performance of the S&P. Are there sectors that you feel have more upside potential than others as we go into 2026?
So yeah, when we're looking at sector diversification and considering some of the things that we talked about, for example, lower interest rates and possible, deregulation on the financial front. Certainly financials, probably more specifically banks, as well as, those types of companies that participate in capital markets would be overweighting those within portfolios. When you think about the AI build out in terms of things, certain industrial companies for sure were playing into that. Those that are driven by the infrastructure spending and CapEx. Certainly, the industrial sector would be somewhere we'd be looking to overweight. And then in addition to that, we talked a little bit about power generation and how that's supposed to go up and data centers and how much power is needed for those types of situations. And, certain companies within the utility space certainly would play into that. So those would be the ones off the top of my head that I would mention in terms of things. And again, those more based around those themes that we talked about within the presentation.
Hey, thanks, Bob. Hey, Mark, I'm going to try to squeeze a real quick one in because I know we've got, some business owners also on the call here today. Just headline, if you're a business owner, what are you paying the most attention to as we're into this year?
So, we think you should see an increase in customer activity. Really as we talk about the lagged effect of economic stimulus really starts to flow through. Those manufacturing new orders are going to flow through to eventually, something for your business likely. And it obviously depends on what you produce. If you're a manufacturer, you're probably going to see the impact earlier. than if you're, somewhere later, and if you're a service provider, that likely comes in to the process later. So, things do look pretty good for business. Interest rates have come down, so it might be a good time if you do have any high rate debt with your business. Maybe look to refi. That could also be a good opportunity. And you have a great opportunity to invest in growth. So, with the 100% appreciation with the OBBA in effect, you can go and you can do that expansion and take that entire write-off in 1 year. And that can really, dramatically decrease the cost today. And effectively, typically you're going to finance, some type of expansion. And in a way, your tax savings can be equal to your down payment. So that sets up a really good opportunity to expand.
All right. Great stuff, Mark. And I think great point for us to wrap up. So look, we're here to serve you. If this prompted any additional questions that you want follow up, please reach out to your advisor or any of us, and we'll be happy to get back to you. Mark, Bob, thanks for some really compelling and good materials for us to educate us. I would ask everybody on the call, we will post this full video on our website at Gryphon Financial Partners. And if you use LinkedIn, please follow us. We are putting out content on a weekly, sometimes daily basis that might be helpful to you and your family.